So can TD's new CEO fix this $3-4 billion scandal that TD's facing right now, whatever that number is? There is a big change coming at Canada's second largest bank. TD has announced that Raymond Chun will be its next CEO. And this decision kind of caught a lot of people on Bay Street by surprise. Chun will step in to replace current CEO Bharat Masrani. He'll be retiring in April after 38 years with the bank. That's a pretty good stint there. It is hard to imagine that this leadership change could be coming at a more challenging time. TD, of course, is facing these major issues in the U.S. Over its anti-money laundering program there that's already resulted in billions of dollars worth of fines. Future penalties are unknown. What really surprised a lot of people with Chun is how fast he moved up the corporate ladder. He has been with the bank for a lot of years, but he's only been in the top leadership role since 2021. He was promoted to the head of Canadian personal banking less than a year ago. There is a quote that I saw by Bank of Nova Scotia analyst Minnie Grauman that pretty much sums up what a lot of people are thinking. And he says, the market will not be surprised by Bharat's departure. It will be surprised by who has been chosen as his replacement. A lot of investors had expected, if this change was made, to bring someone from outside with more U.S. banking experience, especially considering what's going on with those U.S. investigations. On a recent call, analysts grilled Chun about his experience handling big problems like TD's current U.S. challenges. He responded quite confidently. He said, in part, when you're running these large, complex businesses that I've run, running into complexity and dealing with regulators and mapping out complex strategies as we move forward has all been sort of in my experience. So he sounds pretty certain that he'll be able to handle whatever concerns come out of this. His main priority now as the CEO, trying to get things back on track, cleaning up all the issues the bank's having with those U.S. regulators. It already cost the bank that loss of the $13.4 billion acquisition of First Horizon. So there's the ramifications out there are real. Now, as for his part, Masrani, he did take full responsibility for TD's current issues. He said, this took place on my watch as CEO, and I will take full responsibility. As for Chun, there's no other way to say it other than the trajectory his career has seen has been pretty impressive. He was born in South Korea. He moved to Canada as a child. He's been steadily rising through the ranks at TD, joined way back in 1992, so he's been there for a long time. He is more reserved by nature. He said he's had to push past that to succeed. So there's no doubt that this next chapter, this is going to be the biggest challenge that he's had. Full disclosure, I'm a TD shareholder. I'm sure cheering for him. Will last week's Fed rate cut in the U.S. trigger a recession? The Federal Reserve, they just slashed interest rates last week, 50 basis points. That is a move that, according to Chair Jerome Powell, is aimed at keeping the U.S. economy in good shape, as he called it. This cut, it probably seems like sort of good news for growth. But if we look at the Fed's track record, it shows that these rate cuts usually come just before a recession. And that leaves a lot of people wondering, what's next for the economy. If we think historically, the Fed cuts rates when it expects things are getting worse. That's the tradition. That's the way we've always sort of viewed this type of a cut. And if we strip out the pandemic-related moves, there have been 6 rate cut cycles since 1990. In most of these cases, a recession followed within 18 months. With this in hindsight, though, obviously some economists are wondering, they're a little bit on edge, as one of these key recession indicators that goes along with the rate cut is already flashing. And I'm talking here about the job market. When we look at past rate cut cycles, unemployment tended to rise. The average increase in unemployment has been about 1.4% a year, or rather 1 year after the rate cut. In 4 out of the 6 cases, unemployment went up by at least 1 percentage point. That began after the Fed began cutting. Inflation, on the other hand, that's a bit harder to predict if we use history as a guide. Sometimes we see the rate cut, it leads to higher inflation. That kind of makes sense. We saw that in 1996. We saw that in 2007, where inflation spiked a year later or so. There's other times where inflation has actually cooled down, especially when things like rising unemployment caused consumers to spend less. So this is one of those quagmires that we might find ourselves in here. With the cut last week, there was one Fed governor, Michelle Bowman. She expressed concern about the recent cut. She said it could be unnecessarily large, that could increase demand and spark higher prices. So she, for one, is concerned there. Wherever we go here, the big challenge the Fed has right now is to keep growth steady without triggering another inflation surge. Imagine that you're planning for your future, you're balancing the need for growth, the desire for steady cash flow. Maybe you're thinking about retiring early or funding your child's education. The BMO Balanced ETF could be the solution that you're looking for. It is a carefully crafted mix of global equities, fixed income ETFs from BMO Global Asset Management. They're designed to help you grow your wealth while at the same time managing risks. What's more, the fund automatically rebalances every quarter to keep your investment strategy on track, even when the markets shift. You're not just investing in a portfolio, you're investing in peace of mind, knowing that your money is managed by a name that you can trust. Explore how the BMO Balanced ETF, the ticker is ZBAL, can fit into your life and help you reach your goals. Visit BMO ETFs today to find out more. Are you waiting for the perfect time to buy a home? The Canadian housing market right now is in a holding pattern, according to the Canadian Real Estate Association, or CREA. In August here in Canada, we saw a 2.1% drop in home sales compared to the same time last year. It's starting to look now that a lot of these potential home buyers are just, taking a little bit of time to remain cautious here and waiting for better mortgage rates. We did see in July sales rise slightly. The numbers were up 1.3% there, but the major markets have yet to see any rebound. This comes in the face, or despite of the fact that the Bank of Canada has begun that interest rate cut cycle. The recent rate cut from the bank that dropped its key lending rate to 4.25% now, third consecutive rate coming down from 5%. And virtually every economist that I follow now is forecasting more rate cuts coming, possibly dropping to 2.5% by mid-2025. So probably in about a year, we should expect another couple of basis points, another couple of percentage points to come off of the rate from where we are now. Buyers, when I look at this, they seem to be holding off and they're expecting more affordability in the future. That's what happens when you're looking forward. You're expecting the rates to go lower. It might cause you to be a little bit more hesitant to jump in right now. To help more Canadians get into the housing market, the federal government has updated its mortgage rules, as I reported on this channel last week. Starting in December, the price cap for insured mortgages, that's going to rise from $1 million to $1.5 million. First-time buyers will be able to access 30-year mortgages as well. And these are designed to help more people get into homes with less than a 20% down payment. It's designed mostly to benefit those who are purchasing a newly built homes. So we're seeing these slower sales, but there are some signs of life out there. Mike Heddle, he's a broker at Royal LePage State Realty in Hamilton. He says that he has noticed a rise in property showings recently. He suggests that buyer interest may be returning. He says, before the property is sold, we've got to generate offers. Before we generate offers, we've got to generate showings. He added to that, if there's a leading indicator in the marketplace, that might be one of them. So again, with these rates expected to drop further in the coming months, there's not a ton of pressure on buyers right now to jump in at this very moment. Even with the recent bank cuts, it's probably going to take some time to see how it all plays out. We're seeing a new trend in the workplace these days. Why are more and more employers forcing workers back to the office? A lot of them, including the federal government here, large companies like Canada Life, TELUS, they're now requiring employees to be in the office at least 3 days a week. And this is a shift from the earlier days, of course, during the pandemic, where remote work was pretty much widely accepted. This is sort of signaling to me that there's a more of a trend, a move back towards traditional office work. With the federal government, it recently increased its in-office requirement from 2 days to 3 days, stricter rules even on that on executives. And now we've seen some private companies starting to follow suit on that. Examples are Canada Life, Manulife. They cite the need for collaboration and training for new employees. So they want people back together in groups, not just talking to each other on the telephone or on the Zoom type meetings. Now, some of the companies, and TELUS comes to mind here, they've even gone so far as offering severance packages to employees who are unwilling to return to the office. They just don't want them around. TELUS spokesperson Brandy Merker says that this represents an evolution to the way we've worked over the last few years. So no doubt there is this back to the office trend, but there's also a bit of a pushback trend developing, and some unions are stepping up. They're resisting these new policies. A big one, the Public Service Alliance of Canada, PSAC, they represent federal workers. They've protested on this, and they're arguing that remote work actually boosts productivity. It improves work-life balance. Everybody can be the judge on that one. In a pretty big victory, at least for now, the union at TELUS call center staff, they've gone a step further and they've actually secured a temporary injunction that blocks mandatory office while they're awaiting arbitration on that. But even in the face of this pressure here, employees are holding firm. It may be part of survival. When we look at real estate occupancy rates, yes, they are up from the pandemic lows, but they actually, believe it or not, remain below what we saw in the pre-pandemic levels. So that is a potential problem. In Ottawa, just 49% of workers have actually returned to their offices. A couple other cities, Toronto and Montreal, they're averaging only around 60% of workers who have actually returned to the office. I'm here on Mondays and Wednesdays typically to provide this update. If you haven't subscribed, go ahead and do that now. As always, I thank you for watching and we'll see you in the next video.